Welcome to another FAR walkthrough video. I'm Logan, and in today's video, we're going to be going over how to adjust a statement of cash flows to correct errors. And we're going to be doing that the SuperfastCPA CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam, and again, it is free, it's only 1 hour long, and we will show you how to be effective and efficient with your studying so you don't waste any time. Also, just letting you know, we will only be going over 5 questions in this video, whereas SuperfastCPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a SuperfastCPA member. With all that said, let's dive straight into the questions. All right, here we are at question 1, and one thing I just want to point out, a lot of this is assuming that you know how to prepare a statement of cash flow and that you understand some of that stuff. So a lot of this, if you haven't already learned how the different activities work, this might be difficult. Just wanted to throw that out there at the beginning, so let's dive into question 1. A company had a beginning cash balance of $200,000. During the year, the company reported the following cash flows. So they had net income, and remember this is the indirect method, so that's why we're using net income. Depreciation expense, decrease in accounts receivable, increase in inventory, decrease in accounts payable, purchase of equipment, and proceeds from issuing bonds. The company reported an ending cash balance of $640,000. Calculate the correct ending cash balance and identify the likely error that led to the incorrect balance. Okay, so right there it's telling us that $640,000 cash is not what it should be ended as. So we basically need to calculate the cash flow and the ending cash to see where the error occurred. So again, assuming you know how to do this, you can go ahead and pause the video. If not, that's okay, we're going to dive straight into the answer and maybe give you a little bit of a refresher on how these different activities work. All right, the answer is B. It should have been $590,000 of cash, and the reason is because the purchase of equipment was not recorded. So let's walk through this to see how we got there. So first we have to figure out the cash flow from operating activities. And remember, when it comes to operating activities, that's where we have this net income. We start with net income and make adjustments from there. So we adjust for the depreciation expense, we add that back. We add back any decrease in accounts receivable. We subtract any increase in inventory. We subtract any decrease in accounts payable. And all that together gets us $300,000 plus $40,000 plus $25,000 less $15,000 less $10,000 gives us $340,000 of cash inflow for operating activities. And just a reminder, because we're not going to dive super deep into this as we go through, the depreciation expense, we add that back because that decreased income, but no cash actually left the account because of that, so we have to add that back. For the decrease in accounts receivable, that was money that we were supposed to receive, and now that accounts receivable has decreased, that means we received that cash, so that's why we increase the net income from that. With an increase in inventory, it's assumed that you're spending money on maintaining or purchasing that inventory, so that's why you subtract it. For the decrease in accounts payable, that means that you actually paid your liabilities off, so that decreases cash as well. Now let's go to the investing activities. There was the purchase of equipment. That was $50,000 of outflow, so that's negative $50,000 right there. And then the proceeds from issuing bonds, that's $100,000. That's a $100,000 inflow for financing activities. So you add that all together, the $200,000 beginning cash balance, the $340,000 cash inflow from operating activities, the $50,000 cash outflow for investing activities, the $100,000 cash inflow for financing activities, and that gives you $590,000. So the difference is $50,000, and pretty clearly it's because they didn't subtract this outflow for the purchase of the equipment, because if they had, it would go from $640,000 down to $590,000. So we found the error, most likely. You know, sometimes it's not so clear cut, but for this question and for these purposes, that's what we're assuming. So the error was that they didn't record the purchase of equipment, and the correct ending cash balance should be $590,000. All right, let's go to the next question. All right, here we are at question 2. A company has provided the following cash flow statement details. So for operating activities, they put net income, depreciation expense, decrease in accounts receivable, issuance of common stock, and increase in inventory. So again, those are the things that they're saying affected operating activities. Investing activities, they had the purchase of equipment, proceeds from sale of land, and the payment of dividends. And the financing activities, they had repayment of long-term debt and proceeds from issuing bonds. Now, as we were reading through that, you already might have noticed some of the things that were in places they shouldn't have been. So the idea behind this one is we have to identify the incorrectly classified accounts and then put them where they should be so that you have the correct cash flow for each type of activity. So pause the video if you need to, think about this, and when you're ready, come back. We'll look at the answer together. Okay, the answer is B. Issuance of common stock should be classified under financing activities, and payment of dividends should be classified under financing activities. So let's walk through this. In the statement of cash flows, an issuance of common stock is a financing activity because remember, financing activities have to do with long-term liabilities and equity. And when you issue common stock, you're raising funds by giving out common stock. So you get money, but that is an equity account. And then the payment of dividends is also a financing activity because that is something where you're distributing earnings from retained earnings to shareholders. So again, that's another equity account. So those both should be affecting financing activities. So to correct that, you would move that common stock from operating to financing activities, and then you would move the payment of dividends from investing to financing activities. And this is another thing that could happen. People might get confused and put the incorrect cash flows into the incorrect areas or activities. So you might have to correct that and move it around. Let's go to the next question. All right, here we are at question 3. A company purchased a building for $500,000. They made a down payment of $100,000 in cash and put the remaining $400,000 on a note payable. During the year, the company made principal payments of $50,000 on the loan and paid $20,000 in interest. The company included all of these transactions in investing activities on the statement of cash flows. Determine the correct classification for each cash flow related to this transaction. So they had a whole bunch of different times that cash left the account because of this purchase, but they put it all into investing activities. Is that correct? Or are some of these needing to be in different activities like operating or financing? Now remember, operating activities has to do with current liabilities, current assets, net income, and operating expenses and things like that. Whereas financing activities has to do with long-term liabilities, and equity and investing activities has to do with long-term assets and investments. And we've talked about this in the previous video, so if you remember, that's great. If not, let's go ahead and go to the answer to get a refresher. All right, the answer is C. Down payment in cash should be classified under investing, so that's correct. The principal payments should be classified under financing activities, and interest paid should be classified under operating activities. So this is affecting all of the different activities. The down payment, that's just money that you paid straight out to buy the building, and so that does count as an investing activity. Whereas the principal payments, those have to do with long-term liabilities, and so that is a financing activity. And then the interest paid, that is considered an operating expense or an operating activity, and this is something that's typically included in net income. So under the indirect method, you don't really need to make an adjustment for this, but just know that it's not going to be included in investing activities or in financing activities. So again, the down payment is going to be an investing activity, the principal payments are going to be a financing activity, and the interest payments are going to be an operating activity. Let's go to the next question. All right, here we are at question 4. A company prepared its statement of cash flows using the indirect method but made several errors in the operating activities section. Review the following adjustments made to net income and identify the errors. So we have to look at what they did. So they have the net income, they added a depreciation expense, they added an increase in accounts receivable, they subtracted an increase in accounts payable, they added an increase in inventory, they subtracted a loss on sale of equipment, and they subtracted a decrease in accrued liabilities. So again, we need to identify the errors and correct the adjustments for the operating activities section. And just by looking at this, you might notice some things that you know are done incorrectly. So if you've done this before with preparing the cash flow statement in the previous topic, or you just kind of know how to do this, go ahead and pause the video and think through these different things and figure out which ones are done incorrectly, and then we'll look at it together. All right, the answer is A. Increase in accounts receivable should be subtracted, increase in accounts payable should be added, and loss on sale of equipment should be added. So let's walk through this. They have the depreciation expense. They added that, and that is correct because a non-cash expense that reduces net income should be added back to represent that it didn't actually affect cash. An increase in accounts receivable, this means that the revenue was recognized but not collected in cash. So $30,000 should be subtracted from net income, not added. So that was an incorrect thing. So instead of adding it, they need to subtract it from net income. For the increase in accounts payable, an increase indicates that expenses were incurred but not yet paid in cash. So that's actually, as far as the cash flow statement goes, that's good. They saved money because they didn't have to pay expenses, so you add that back to the net income, you don't subtract it. So that's another thing that they did incorrectly. And then for the decrease in inventory, this means that inventory was sold and converted to cash, so $10,000 should be added back to net income. They did that correctly. And the loss on the sale of equipment, this should be added, not subtracted, because it represents a non-cash loss that reduces net income. So they reduced net income but again, there wasn't actually any cash that left their account because of the loss specifically. So they have to add that back to get the correct cash flow. So they did that incorrectly. And then finally, the decrease in accrued liabilities. This should be subtracted because it indicates that liabilities were paid down, reducing cash. So they did that correctly. All right, that makes sense. You just have to make sure you pay attention to how things work, especially with the operating activities. That's where I think most people can get confused. So make sure you remember that an increase in accounts receivable actually decreases cash, and a decrease in accounts receivable actually increases cash for operating activities. And again, we're talking about the indirect method here, which is the only thing that matters for the CPA exam. Now with that, let's go to the next question. All right, here we are at question 5. A company prepared its statement of cash flows using the indirect method. Review the adjustments made to net income and identify the errors. So they had net income, they added depreciation expense, they subtracted interest paid, they added dividends received, they subtracted an increase in inventory, they added an amortization of intangible assets, and they added a purchase of treasury bills, and they recorded that in the investing activities, by the way. So look through these, think about what they did. So each of these is things that they actually did. So assume that they did reduce or increase the cash for each of these things. Think about what we learned in the previous video if you watched that, and come back when you're ready. All right, the answer is A. The interest paid and the dividends received should not be adjusted in operating activities, and the purchase of treasury bills should not affect investing activities as they are cash equivalents. Now, this might be a little bit confusing. You just need to remember how this works, so let's go through it. In the indirect method, the net income already includes certain items, and adjustments should avoid double counting. So anything that's already included in net income, we don't need to make an adjustment for that, unless it was some kind of non-cash item like depreciation expense and so forth. But for the interest paid, they had $25,000 that should not be subtracted from operating activities because it is already included in net income correctly. Interest payments are typically classified as operating activities under GAAP. So they already paid their interest in their net income, and cash already left the account, which is why you start with net income and then you just make the necessary adjustments, because net income a lot of times does have most of the correct cash adjustments. You just have to adjust for a few more things. Then you go to the dividends received, similar thing. That dividends, the cash that they received for that was already recorded in net income, so they don't need to add it to the net income again. That would be double counting. And then finally, for the purchase of the treasury bills, these are cash equivalents, and for anything that's considered a cash equivalent, this is something you don't necessarily need to record in the activities because you're basically trading cash for a cash equivalent or more cash. As far as the cash flow statement is concerned, nothing is changing. So these don't impact the cash flow statement in that sense. And with that, we learned a lot in just 5 questions. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics with SuperfastCPA is as you're going through the questions to learn the material, you will notice the things that keep popping up. You will notice how they're teaching you to calculate operating activities. You will notice the things that they keep throwing in that are obviously important, so you write them down as pillar topics so that you know them for later. It's kind of a summary of the most important things you learned from the questions. So let's go to the pillar topics for this video. All right, here are the pillar topics, and again, it's just kind of a summary of what you might have learned from this. So first, you have to ensure that all cash transactions are correctly classified into operating, investing, and financing activities, as misclassification can lead to inaccurate reporting of cash flows. So that could be a mistake that you have to fix, is things being classified in the incorrect activities. When using the indirect method, you have to avoid making adjustments for items that are already included in net income, such as interest paid or dividends received, because that would be double counting, so you want to avoid that. Also, you have to identify and exclude any non-cash transactions, such as depreciation and amortization, from cash flow calculations, ensuring that they are only used as adjustments in the operating activities section. So again, remember that non-cash things should be added back to net income, such as depreciation and amortization. And then finally, I think this is the thing that's hardest to remember and is the thing that you will probably get wrong the most if you're not careful. You have to remember that increases in current assets and decreases in current liabilities reduce operating cash. So an increase in accounts receivable and a decrease in accounts payable would reduce operating cash. And decreases in current assets and increases in current liabilities increase operating cash. So it's kind of flipped, could be a little bit confusing, but just remember that's one of the pillar topics, and that's something that you need to remember to look for and make sure you adjust if that's necessary. And with that, that is the end of the video. Before you go, make sure to check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's only 1 hour. It is free, and we will teach you how to pass the CPA exam without wasting months or even years of your time. Also, we only went over 5 questions in this video, but just remember that SuperfastCPA CPA members will have access to the full 10-question video when we post it in the members forum. So, if you liked the video, if you liked what you saw here, you can get more of it by becoming a SuperfastCPA CPA member. Also, if you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.